2011 interview with Jerome Powell has given us a secret roadmap for what the Fed is doing right now. A lot of people are wondering, will there be a soft landing, a hard landing, no landing at all? And we have a couple of pieces of information that will make it extremely clear what the Fed is trying to accomplish. And by reading between these lines and anticipating some of these moves, I believe that there is one of the biggest plays in the history of financial markets to be made right now. You have to understand the ultimate goals and how the machine works. So let's go through this insane revelation that's coming from none other than Jerome Powell himself in an interview he conducted in 2011.
So bad economic news drives people out of stocks and into bonds. And when people go into bonds, they bid up the price of bonds, and that bids down the interest rate that the government is required to pay. So that's what's happening now. We had bad economic news last week. Another thing that draws people into our bonds is the turmoil in Europe, as it becomes more and more clear that the Europeans have not figured out what to do with the potential default of some of their major nations. And so global money tends to come into Treasury securities at that time. So that's what's going on.
Remember, at this time, Jerome Powell was not the chairman of the Federal Reserve. He was just a visiting scholar that was appearing on C-SPAN. But what he said is very profound, which is that essentially bad economic news drives people out of the stock market and into bonds. Effectively, they buy the US government debt. That is precisely what the government needs to do, and I'll show you this in one chart. This chart is the Treasury General Account. This is effectively the amount of discretionary spending that has been floating the economy, and it's the thing that has been offsetting the government's default on its debt. You see, there's all this excess cash in the bank, their TGA, that affects how much liquidity is in the markets. But ignore all that. What you need to understand is since 2021, this account has gone from almost $2 trillion down to $61 billion. And $61 billion might seem like a lot of money, but it certainly ain't when you're trying to uphold the entire US economy. So understand, their goal is undoubtedly to replenish this by selling US bonds. That means that roughly they'll need to sell over $1.5 trillion in US bonds in order to get this account back to health. Now, whether or not they make it there is a big question. But you better believe from Jerome Powell's own mouth that that is the goal. So how do they do this? Because in the end, if people don't really want to buy bonds, they're going to have to pay an exorbitant amount of interest in order to sell those bonds. They'll have to pay a super high interest rate. That means that for every dollar that they raise to get this account back to its health, they'll need to pay a higher amount of interest on that debt. But only if there's not a ton of bad economic news driving people out of stocks. Now, first, I want you to understand that the stock market, while it is pushing back up to its prior highs, specifically the S&P 500 and those big indexes, let's go ahead and take a peek under the hood and understand what might be driving some of that health. Listen to this. It's actually shocking.
Say if there was a basket of 500 stocks, and I told you the total return of 495 of them was zero.
By the way, he's talking about the S&P 500 here and talking about how 495 out of those top 500 have returned net zero gains in 2023. Go on, Kevin.
And just 5 of them were driving all of the gains for 2023. Well, this is actually what's happening. The S&P 500, which is made up of 500 stocks, is being driven solely by 5 stocks. And those companies are Apple, Nvidia, Amazon, Microsoft, and Google. If you remove those 5 stocks, the average return of the S&P 500 for 2023 would be 0. Instead, the S&P 500 together is up a total of 10.3%. Year to date, thanks to 5 stocks, just 1%.
So the top 5 biggest stocks in the world are pretty much the only place anyone is putting money. The other 495 stocks in the S&P 500 are completely flat on the year, despite a very, very hot 2023 compared to 2022. So let's draw some assumptions here. We have 5 mega cap stocks, the biggest 5 stocks in the world, that are upholding the entire equities markets. And we know that from Jerome Powell's mouth himself, He needs to see, quote, bad economic news to drive people out of stocks and into bonds. We also know that the Treasury General Account has drawn down over $1.5 trillion over the past year and a half or so, and that they simply need to replenish this account one way or another. And the way that they like to do it is by selling US government bonds and by selling them on the cheap so that they don't have to pay that much interest. They want a good deal. Put this news together with cracks in commercial real estate. What we see is that LA's office towers, right here in my hometown, one just sold for $154 per square foot. The debt on the building is $230 per square foot. They're effectively taking a 33% haircut on just the debt against the building, not even the original value of the building. Make no mistake, this is not an accident. This is the direct consequence of going from a zero rate environment, a free money environment where people could just borrow like crazy, and then jacking up interest rates at a historic pace. Not only that, but planning to keep hiking even though things are breaking. That's because what they don't want to tell you, the quiet part that they don't want to say out loud, Mr. Chair Jerome Powell doesn't want to say that they absolutely need things to break. They need things to break not only to control inflation, but they need things to break to drive people into US government debt. And if they don't get people to panic out of the stock markets and start buying bonds, then they'll have to pay way too much money to replenish that account. And they don't want to do that. So don't listen to me. Listen to Fed Chair Jerome Powell in his own words in 2011. They need bad economic news, and they need it badly, or else they won't be able to fill up their coffers and keep paying for government expenses with any kind of reasonable interest rate. But I know what you're thinking, Elliot, what the hell does this have to do with crypto? What does it have to do with my Bitcoins and my Ethereums and my Solanos? Well, I'm here to tell you it has a whole hell of a lot to do with those things. In the end, we don't know exactly how Bitcoin is going to perform in this economic drawdown, if we get it. Let's imagine that one of these 5 stocks, or maybe all of them, start to have some cracks, some lower earnings caused by panic in the real estate markets. I don't know, this is just hazarding a guess. We might start to see weakness in those 5 stocks, which would literally be weakness across the board in the stock market. Now, we know that in recessions, things like bonds and things like gold tend to do well. Is Bitcoin going to be priced like digital gold? If so, we might see a growth in the Bitcoin price. Is the China narrative going to bring new liquidity into Bitcoin and crypto? Maybe, but it might take a while for that to mature. The big thing to understand here is that when that bad economic news happens and the government is trying to drive you into buying its own debt, the obvious move, in my opinion, is to DCA in and start collecting equities and other assets when they're on fire sales. That's why we've been keeping a ton of dry powder on the side here, buying little by little into the markets, just in case we get this black swan-like crash. And if we do, I believe that's the time to load up on your favorite tech stocks, your favorite cryptocurrencies, while everyone is flocking into cheap government debt. I believe that that is precisely the opportunity. Again, there are a lot of variables here. We don't know exactly how this is going to play out, but this clip by Jerome Powell is an absolute superpower in understanding the true goals of the Fed over the coming months and years. As always, if you enjoyed this, you know what to do. Make sure you're following me on Twitter. I've been covering a lot of cool stuff here. One of the new trends that's been popping up in crypto land that I haven't seen anything like this in quite some time is liquid staking derivatives. Kind of reminds me of early DeFi days. And so I've been tracking inflows of liquid staking derivatives. As I've said before, I cover different stuff on Twitter, and I talk about even different stuff in the Discord groups that I'm a part of, because a lot of this stuff is super risky, but I find it fascinating. And you know me, I'm always obsessed with what's happening next in crypto land. So make sure to follow me on Twitter at EllioTrades if you want to see me talk about a little bit deeper, a little bit more advanced topics, especially concerning new narratives and new types of coins in crypto. As always, if you enjoyed this video, make sure to click on this one popping up right here. It's even better than the video you just watched. We talk about literally how the machine works, how money works, how to actually spot opportunities in the markets. And I believe we are setting up for one of the biggest opportunities of a lifetime. As always, I'll see you soon on the next episode.